Bala Subramaniam, Chief Executive Officer of Birla Sun Life Mutual Fund, joins us. Bala, good morning. Thank you for joining us. Bala, what's happening? When we started the year, things were looking rosy, things were looking bullish. But 6 weeks into, 6 weeks of trading into this year, things are now looking scary. Mid-cap stocks have corrected and the large-cap stocks are looking rusty.
Yeah. Morning, Kunj. I think the year began with a good note. One, from the point of view of huge amount of flows that has come from foreign investors, which is a big positive news. And second is huge amount of supply that has been coming, both from the public sector institutions as well as some of the other private sector placements have also been getting accepted and absorbed in the market, which again a good sign, which is essentially nothing but the equity investments is coming back, both from the institutional investors as well as the participation coming from HNIs. Having said that, ultimately the quarterly results have to, of course, play a role with respect to the building up momentum and the direction of the market. And second is now is the head of the budget, some bit of expectations toned down has to also happen. And third, the huge amount of supply that is coming and hitting the market, and the domestic institutions continue to be net sellers. That I would assume that is putting some kind of cap on the overall momentum what we have seen in the whole of last year and the beginning of the year.
Do you expect some amount of pre-budget excitement or pre-budget rally to kick in this year?
Yeah, I think the way we look at, we only go by what the government has been doing for quite some time with respect to carrying out some of the pending reforms initiatives. If we go by that, there has been a lot of tough decisions have been taken, merely to ensure that the fiscal has to be contained. I think the first and foremost is fiscal has to be contained. At the same time, we need to ensure that sufficient money is being generated to put money in the various infrastructure needs. And third, of course, some solutions have to be found to see to it that rupee stabilizes somewhere around the current level, without, of course, putting pressure on further depreciation, which is largely coming on account of current account deficit being very alarming. Keeping all those in mind and the way, the speed at which the government has been taking decisions in addressing every issue that pertains to both fiscal as well as the twin deficit, what we can call it, I would only assume that the budget would set an expectation from the overall market perspectives that would be probably better than what I think the general expectation has been there. Whether there is a pre-budget rally or post-budget rally, I think the way we look at things are coming back to normal, and things are also now getting better, mainly to deliver better GDP growth as we move forward. And corporate results is, of course, reflects in the prices of the companies. At the end of the day, whatever we are witnessing in terms of companies' performance, it reflects in the stock prices. And anything that happens actually from here onwards, more with respect to supporting actually the various sectors in the industry, would only have a positive impact as we move forward. Maybe as it happens every year, the pre-budget rally and post-budget, the reaction to the budgetary provisions, while it is bound to be there, but I think what we are seeing is directionally is getting into the positive territory.
Bala, what is it that you're hoping to hear from the finance minister this budget? Because the market is going extremely cautious and weak into the event.
I think clearly the expectations at this point of time is only on one count, which is the less populist in nature. Whatever the budgetary provisions would come, as long as it is not populist in nature, given the fact the next year is the election year, I think the market will see it positives. And second, it will also once again will prove a point that the government is serious in terms of building certain credibility on the focus on fiscal corrections. And second, with respect to the taxations, not much is being expected, except of course there is an increased level of expectation that is now getting built up, that increasingly the people at the higher end of the tax bracket will be taxed, as we have seen actually in the US. From the government point of view, we have of course a limited source through which they can get the tax collections go up. At the same time, they need to also support the industry, mainly to bring back the sentiment and also they encourage actually more and more investments to come from private sectors corporates. So in that sense, the budget the likely to be somewhat balanced, which is more in supportive of more in the nature of supporting the growth as we move forward.
Okay, we've gone below 6,000 on the Nifty, and now we've gone below an important psychological level. Bala, at a time when the institutional activity is not all that negative, so if domestic institutional investors are selling, foreign institutional investors are buying, so the force of buying and selling is getting balanced. Why are mid-cap stocks under intense pressure? Most of the key mid-cap stocks are the winners of 2012, real estate, some banks, some asset owners, they are down by a good solid 15 to 20% from the recent highs.
Yeah. I think as you rightly put it, the domestic institutional investors continue to be the net seller in the market. And despite that, we are seeing an index trading at about 6,000, which is nothing but the large flow of that money that has come from global investors as well as the domestic investors. One need to also accept the fact that the large flow of money that has come into the market have come in through the ETF route. It's come large into the large caps, where the large pool of money that can be invested in the market, it can get absorbed. They'll be able to buy, execute their buy trades very efficiently without impacting the stock price. That's why we are seeing actually the large cap continues to perform better than the market. And second, from the mid cap point of view, wherever the quality of earnings is far superior, the market has been rewarding them. At the same time, so wherever there has been any disappointment in nature or any change in the company's progress with respect to what was expected in the beginning of the year or maybe through the year, and those who have not, as long as they have materialized, the stock prices remain stable, and as long as they don't materialize to the expectation of the market, and the punishment also is equally as bad. At the same time, when the domestic institutional investors continue to sell, it's of course a mix of everything. It's not just only focused on large cap, it will even cover the mid cap stocks. In some sense, I would only assume that some bit of supply could also come from the domestic institutional investors. But largely, if you look at the way the market has been behaving, wherever the quality of earnings is good, wherever the management confidence in terms of building the business is very high, and wherever the outlook that is being painted by these companies as we move forward is far higher than the analyst expectations, they continue to perform better in the market.
So Bala, sectorally, what is it that you're liking right now?
Clearly, as a fund house, we've been quite bullish in the last few quarters rather, in some of the sectors like banking and financial services. In the recent past, we had to increase the exposures into the banking and financial service sectors from about 23% to maybe about 28%. We've also been turning reasonably bullish on the cyclical sectors, not necessarily the infrastructure companies, but necessarily the companies which will benefit out of the interest rate cycle turning better actually for the coming year, which is largely coming from the automobiles and certain capital good sectors. These are the two sectors on the cyclical nature, but directly linked to the interest rates movement as we move forward. The other sectors where we continue to stay overweight positions compared to the index weight, which is in the pharma sectors very selectively, mainly in owning actually the domestic pharma companies on the basis of the kind of huge potential what they have with respect to their exports market. Lastly, of course, is the neutral weight to the IT as a sectors, given the fact that the last few months they have been actually, given the broad market, they may tend to outperform the market on a relative basis. Hence, we have a neutral position actually in the sector.
But Bala, do you think at least in the short term Indian markets are pretty much stuck between rock and a hard surface? One side you've got consumers which are slowing down, and on the other side you've got the investment drivers which are not kicking in. So consumer is slowing down and the investment cycle is yet to pick up.
Yeah, I think clearly whole of last year, one of the area of concern what we had is while we all of us remained bullish on the hope that the economic recovery will come back. Clearly, the area, as you rightly put it, consumption demand in general, we saw it coming down, which of course reflects today on some of the sales numbers what we're witnessing on automobile sales. Even the consumer companies do actually face the pressure of the sales as well as the margins. Having said that, at the end of the day, the large pool of consumption demand, which has been the primary driver for the Indian economic growth, cannot be taken away that easily. Which essentially means that one good harvest season would get back actually the consumers' behaviors back to normal. And having said that, they'll also now need to get the sufficient support from both the private sectors as well as in the public sectors through the various government initiatives in reviving the demand on the infrastructure segment. That's why if you look at from the broad economic point of view, while what is said is right from the consumptions relatively now getting muted, they'll also get supported from the other side, which will bring back the overall growth momentum back to normal over 6% plus. From the company's point of view, at the end of the day, the company that focused on the consumers, they have outperformed the last 3 years. During the uncertain period in the economy, they tend to outperform, they continue to enjoy very high market cap, high P valuations. In some sense, I think the current market is also looking at a different segment of the market to perform. I would assume that some bit of corrections which now happens, which we actually put out a theme this year, the mean reversion which could happen in every sector this year, which essentially means that whatever has done significant outperformance in the market for the last 3 years, they will probably underperform this year, given the fact that some bit of a balancing act would make such kind of corrections to happen.